Hello, everyone. This is Dr. Swati Mishra once again from International School of Business Management at Suresh Gyan Vihar University. Welcome to yet another session of Indian Business Houses. We have been discussing the various policy changes that were brought in by the government of India post independence. Then we also studied the conditions and the economic conditions, especially that were prevailing in our country post independence. After that, how the different 5 year plans were introduced, what were the success rates of those 5 year plans, what were the different mandates under those 5 year plans, what were the key areas which were focused on for the development purpose under those 5 year plans. We have discussed all of these topics. After that, we also studied how the new economic policy was introduced in India, what were the different mandates under this new economic policy, and how they helped the Indian economy to develop under the new, uh, prevailing situations that were specially created for the development purpose. We also saw the GDP rise after the new economic policies introduction. After that, we also discussed in detail as to what was the new industrial policy that was introduced in India and how it supported the various Indian business houses. We have discussed in wide detail about the different Indian business houses. We have discussed how Tatas and Birlas were prevailing in various different sectors of Indian business houses, and later on, how Reliance also entered. We have discussed the rankings of these business houses under different economic conditions. Today is another session of those economic policy changes that were brought in. What I want to discuss with you today is some key factors of these economic policies and how they helped the Indian economy to rise, how FDIs were increasing after the introduction of these economic policies. It will also be a revision session of the previous few topics that we have discussed. So moving further, let me just introduce you to the learning objectives of today's session. The learning objectives of today's session are to refresh the details which were discussed earlier about the new economic policy in the previous sessions. Another learning objective is to have a good idea of the pre-1991 economic scenario. We will also be discussing the drawbacks of the pre-1991 economic policy. And this session also aims to enlighten the learners about the advent of the IMF and the World Bank. As far as the learning outcomes of this session are concerned, after this session, the learners will be done with the revision of the new economic policy covered in the previous sessions. The learners will have a good idea of the pre-1991 economic scenario. They will also carry a deeper understanding of the drawbacks of pre-1991 economic policy, and they'll be enlightened about the Indian monetary funds and the role of World Bank in Indian economy. So, as just let me brush up with the topic of economic policy with you as to what exactly we should understand by economic policy in Indian business houses. So, economic policy basically refers to the actions that the governments take in the economic field. It covers the systems for setting the levels of taxation, government budgets, the monetary supply, the interest rates, as well as the labor market, national ownership, and many other areas of government interventions into the economy. And why do we need these government interventions? We have already seen that, you know, the big business houses become the giant whales of the ocean and start eating up the new small entering fishes. And because of which, MRTP Act was introduced. If you remember, we have spoken a lot about it. And what regulations were posed on these monopolistic industries by the MRTP Act? Later on, it was replaced by Competition Act. So we've studied about all of them, and we exactly should understand that what we intend to mean by the economic policy when we talk about economic policy. So, as I told you when I was talking to you about the learning objectives of today's session, that we will be discussing a bit about the pre 1991 economic scenario in India. So, if we talk about the Indian economic policy after independence, was actually influenced a lot by the colonial experience that we had had, which was actually seen by the Indian leaders as very exploitative in nature, and especially by those leaders, exposure to the Fabian socialism. Nehru and other leaders of the independent India sought an alternative to the extreme variations of capitalism and socialism. In this system, India would be a socialist society with a strong public sector, but also with private property and democracy. As a part of it, India adopted a centralized planning approach. And that is why this centralized planning approach basically intended to come up with a policy that would actually create some new reforms in the Indian economy, some bring in some good positive changes in the Indian economic scenario. So, when we talk about this economic scenario and the pre economic scenario, earlier when I was taking the new economic policy sessions, I had told you that India's economy was badly struck by various deformities and malfunctions. And the poverty was extreme in India. There were major problems in Indian economy, and that is why the policy actually tended towards protectionism with a strong emphasis on import substitution, industrialization, understate monitoring, state intervention at micro level in all the businesses, especially in labor and financial markets. A large public sector business regulation was also there. So that is why this, pre-economic scenario that we were having, it needed a greater thought towards the reforms that were supposed to be introduced in the country. And, there were multiple drawbacks. Some of them briefly have been mentioned in the previous session also. Herein, I would like to talk more about these drawbacks of the pre 1991 economic policy. So, when we talk about the pre 1991 economic policy, the uh, drawbacks have been really major. For example, the license Raj that was there. So, this you know license Raj or the permit Raj was the elaborate system of the licenses, regulations, and accompanying the red tape that were required to set up and run businesses in India between 1947 and 1990. So, there were, of course, there have been some major failures post liberalization also, which we would discuss later on. But for now, you have to understand that this, license Raj was actually making, uh, the entry was becoming a major hindrance for the entry of the new entrepreneurs in the Indian industrial sector. Of course, today the high tech industries are receiving a great response towards the government from the government, and a lot of emphasis is there towards entrepreneurial development, and all these things are there. But initially, due to the license Raj and you know the permit Raj, uh, there were so many problems that the new entrants were hesitant in entering the uh, Indian industrial scenario. So if we talk about this license Raj, was actually the system of licenses or regulations, and it was also accompanying the red tape that hindered the setup and running of businesses in India. So up to 80 government agencies had to be satisfied before the private companies could produce something, and if granted, the government would regulate the production. The term is play on the British Raj, which refers to the period of British rule in India. It was coined by the Indian independence activist and the statesman Chakravarti Rajgopalachari, who firmly opposed it for its potential for political corruption and economic stagnation, founding the Swatantra Party to oppose these practices. Then, of course, later on, some reforms since mid 1980s have significantly reduced the regulations, but Indian labor laws still prevented manufacturers from reducing their workforce without prohibitive burdens. So, basically, if we talk about the history, you know, following the Russian Revolution, socialist thinkers in India began drawing the parallels between the pre revolution Russian uh, proletariat and the Indian masses under colonial rule, seeing socialism as a way to empower the poor Indian farmers. Following the independence, these socialist fractions, most importantly Jawaharlal Nehru's conception of democratic socialism, influenced the policies of the license Raj. Following his college studies and 1927 visit to USSR, Nehru had become an avowed socialist and proposed economic plans in the Indian National Congress that stressed the importance of centrally planning in the economy. He saw such government intervention as a way to modernize the Indian economy, which had been left impoverished by decades of colonial rule. However, Nehru did not seek to destroy the private sector as in the USSR, but rather created a mixed economy with strategic industries under state control and public sector corporations guiding investment. The economic centralization and controls required for the war effort during World War II helped create the bureaucratic and manufacturing infrastructure necessary to institute Nehru's plans. And so, following the independence and his election as the prime minister, he had an opportunity to, put his election as prime minister, his ideas into action. So, in his speech to the Constituent Assembly of India, he declared the service of India means the service of millions who suffer. It means the ending of poverty and ignorance and disease and inequality of opportunity. Nehru's ideas were opposed especially by Chakravarti Rajgopalachari, as I just mentioned, who founded the first market-friendly political party, which was known as the Swatantra Party. In late 1950s, Rajgopalachari coined the term quota permit license Raj to describe the Indian system of regulations. And he was actually believing that there was a lot of corruption which was developing due to this. A key characteristic of the license Raj was a planning commission that centrally administered the economy of the country, like a command economy. So India had 5-year plans on the lines of the 5-year plans in the Soviet Union. The Planning Commission was set up in 1950 to survey the available resources in the country and formulate plans to raise the standard of living. That Planning Commission enacted the first 5-year plans in 1951, as we've already spoken about. It aimed at developing the agricultural sector, if you remember. So these were the major problems that were there. Another drawback that was there was the import substitution. So if we talk about the import substitution, first you have to understand what we actually mean by this terminology import substitution. And import substitution industrialization is basically a theory of economics which is typically adhered to by developing countries or the emerging market nations that seek to decrease their dependence on the developed countries. The approach targets the protection and incubation of newly formed domestic industries to fully developed sectors so that the goods produced are competitive with the imported goods. Under ISI theory, the process makes local economies and their nations very self sufficient. So, if you talk about this ISI, which is trade and economic policy, which advocates replacing foreign imports with domestic production, ISI is basically based on the premise that a country should attempt to reduce its foreign dependency through the local production of industrialized products and was intended to promote self-reliance. But this meant that monopoly of Indian industries and lack of incentive for them to improve the quality of products, which actually hampered the consumer interests a lot. So, if we talk about this import substitution, industrialization, the primary goal, as I've told you, was to protect, strengthen, and grow the local industries using a variety of tactics like tariffs, import quotas, subsidized government loans. Countries implementing this theory attempt to shore up the production channels on each stage of the product's development. So ISI runs directly counter to the comparative advantage concept that occurs when countries specialize in producing goods at a lower opportunity cost and export them. So if we talk about the history of import substitution industrialization, you know, it is dated back to the policies in 18th century. So it was also supported by economists like Alexander Hamilton and Friedrich List. So countries initially implemented these policies in global south, like Latin America, Africa, parts of Asia also, where the intention was to develop self-sufficiency by creating an internal market within each country. The success of ISI policies was facilitated by subsidizing prominent industries such as power generation and agriculture and encouraging the nationalization and protectionist trade policies. So these were a few major drawbacks of the pre 1991 economic policy. So there's a little quote that I have for you people here. This is from BBC on the pre 1991 economic policy. And BBC said that before the process of reform began in 1991, the government attempted to close the Indian economy to the outside world. The Indian currency, the rupee, was inconvertible, and higher tariff rates and import licensing prevented foreign goods reaching the markets. The labyrinth bureaucracy often led to the absurd restrictions. Up to 80 agencies had to be satisfied before a firm could actually uh, be granted the license to produce something. And the state would decide what was produced, how much was produced, at what price it was produced and sold, and what sources of capital were used. So that many regulations were there, which were slowly getting converted into corruption. And that was the time by 1990s when the Indian government started realizing that yes, now there is time that we should actually bring in some positive change, some major economic reforms, and which should actually lead to the development of industries, restrict the monopolies of the big Indian business houses, and let the smaller ones also grow into bigger ones. And then we saw the rise of the new economic policy, which we have already discussed in greater details. But I've already told you that today's session was mainly to enlighten you with the drawbacks of why this new economic policy was needed, what were the changes that were brought in. So we all know the main architects behind the Indian economic policy in 1991, Dr. Manmohan Singh, the finance minister then, and Shri P.V. Narasimha Rao, the prime minister of India at that time. And they were the architects of the new economic policy. In 1991, we had also faced an economic crisis, which I would like to talk to you about. By 1985, India had started having a balance of payments problem. This is due to the more expenditure by the government, whereas the income that was generated was far less as compared to the expenditure. In addition, there was huge disparities between the income and the expenditure. By the end of 1990, we were already struggling with famines. We had already faced wars, and we were under a serious economic crisis. The government was close to default. Its central bank had refused new credit. In 1991, India met with an economic crisis relating to the external debt. The government was not able to make repayments on its borrowings from abroad. The foreign exchange reserves, which we maintain to import the petroleum and other important items, they dropped to the levels that were not sufficient to last even a fortnight. That level of crisis had occurred in the Indian economy. And the crisis was further compounded by the rising prices of essential goods due to excessive inflation. On top of it, we were facing extreme unemployment, extreme famines, reduced agricultural growth, and major other problems. And then there was this advent of the IMF and World Bank, and India approached the the International Bank for Reconstruction and Development, which is IBRD, commonly known as the World Bank. And then they approached the International Monetary Fund (IMF) for help, and India received around $7 billion as loan from these two agencies to solve the crisis of the country. It had to pledge 20 tons of gold to the Union Bank of Switzerland that time. and 47 tons of gold to the Bank of England as a part of the deal with the International Monetary Fund. In addition, as a part of the bailout, IMF expected India to liberalize and open up the economy and remove the trade restrictions between India and the other countries. So, this is just a very old cartoon that I'm sharing with you, wherein we can see PV Narasimha Rao ji and Manmohan Singh ji getting the $7 billion from IMF, and they are saying that if anyone asks, just say nobody twisted our arms. We twisted them ourselves because we felt that their arms were considered the arms of India and they were badly twisted. So that time, before proposing the reforms, Dr. Manmohan Singh, in his budget speech on 24 July 1991, said that there is no time to lose. Neither the government nor the economy can live beyond its many means year after year. The room for maneuver to live on borrowed money or time does not exist anymore. We need to expand the scope and the area for the operation of market forces. This was his major quote in his budget speech. And then the 1991 economic reforms came in. We've already discussed them earlier. There were two major reforms, the structural reforms and the stabilization measures. The structural reforms, of course, included the LPGs, liberalization, privatization, globalization. The liberalization was done in different using different tools like deregulation, liberalization in the financial sector, tax reforms were introduced, forex reforms were introduced, trade policies were changed, and slowly, you know, some stabilization measures were also introduced. These stabilization measures are nothing but some short term measures which are aimed at solving some immediate causes or some problems which require immediate actions. They included correcting the weaknesses which resulted in the balance of payments crisis and steps to bring in the inflation under control. The, the structural measures that were taken, they were the long term measures which were aimed at improving the efficiency of the economy and increasing its international competitiveness by removing the rigidities in various different segments of Indian economy. So these reforms fell under three leads, as I just said, the LPG, liberalization, privatization, and globalization. Liberalization was done in various different sectors, following different ways, like deregulation of the Indian industries, different industrial sectors. Industrial licensing was abolished for all, but some particular product categories like alcohol, cigarettes, hazardous chemicals, drugs, explosives, etc. Many industries which were reserved for public sector uh, were now being de-reserved. Only railways, defense equipment, atomic power generation, they were reserved for public sector. Markets were now allowed to determine the prices themselves. So such major changes were brought in under liberalization. There were some financial sector reforms also, like reducing the role of RBI from regulator to facilitator of financial sector. These reforms basically led to the establishment of private banks in India. FDI in banks was raised to somewhere around 50%. But certain managerial aspects have been retained with the RBI to safeguard the best interests of the consumers and the economy. There were major tax reforms also that were introduced. Corporate tax, which was very high earlier, had been gradually reduced. The tax procedures had been simplified and the rates were also revised and they were actually lowered. In 1973-74, 11 tax slabs with rates from 10 to 85% were there. 1990-91, in 5 budgets between 91 to 96, uh, the finance minister Manmohan Singh ji reduced IT slabs to 3, 20, 30, and 40%. Foreign exchange reforms were also done. The rupee was devalued against foreign currencies, which led to an increase in inflow of the foreign exchange. Markets had been allowed to determine the foreign exchange rates. There were multiple trade and investment policy reforms also that were introduced, like the dismantling of the quantitative restrictions on imports, reduction of the tariff rates, which means the taxes on the imports, removal of the licensing procedures for imports except in case of hazardous and environmentally sensitive products. Quantitative restriction on imports was also fully decreased later. Export duties have been removed to promote the exports. Privatization was also brought in. Privatization basically means the transfer of assets from the public sector to the private sector. Privatization actually helped in improving financial discipline and to facilitate modernization. Privatization helped in strong inflow of FDIs, disinvestment, privatization of public sector enterprises by selling of part of the equity of PSEs to the public is actually called as disinvestment, right? So, of course, there were some criticisms also to this that the assets of PSUs had been undervalued and the money from the disinvestments were diverted to meet the shortage in the government revenue rather than in creating new assets. So, these types of criticism were faced by the government that time, which had introduced privatization. And later on, of course, let's talk about globalization also. We all know that it is a process of international integration arising from the interchange of worldviews, products, ideas, and mutual sharing, and other aspects of culture also. And of course, outsourcing was introduced. In outsourcing, a company hires regular service from external sources, which was hitherto provided internally. It is an outcome of globalization. Thanks to the new economic policy, India became a major source for outsourcing jobs. Example, BPO, banking services, etc. World Trade Organization was established to administer all multilateral trade agreements by providing equal opportunities to all countries in the international market for trading purposes. India has been an active member of WTO, which aims to enlarge the trade between the countries. And there is another quote that I want to talk to you about from the same speech, the budget speech of Dr. Manmohan Singh ji in 1991. I do not minimize the difficulties that lie ahead on the long and arduous journey on which we have embarked. But as Victor Hugo once said, no power on earth can stop an idea whose time has come. I suggest to this august house that the emergence of India as a major economic power in the world happens to be one such idea. Let the whole world hear it loud and clear. India is now wide awake. We shall prevail. We shall overcome. So this was actually said by after he had proposed the reforms. Later, if we try to just assess the economic reforms, you can see on your screen that how the movements of foreign exchange reserves increased slowly from March 91 till March 2006. I have a graph till March 2006. It shows a constant increase. If we see the GDP earlier post independence was very low. 1975 onwards, it started increasing a bit after some good 5-year plans came. And post 1990, 91, it has shown a very steep rise. FDI flows inwards have also increased a lot after 1991's economic policy introduction. We can also see the GDP percentage here. Service sector has shown the major rise. Industrial sector has also been increasing consistently. Agriculture keeps on increasing and decreasing, and there have been some major fluctuation. And you know, this is just a cartoon that was published. If you can actually understand the meaning, a bit controversial cartoon. So I will not talk more about this in this session. With this, we have come to an end, and I have spoken to you about the drawbacks of the pre 91 policy, and I've also spoken to you about the idea behind the 91 policy and how it slowly improved the condition of economy in India. So with this, we have almost discussed the entire new economic policy of India in detail. And I hope the sessions of Indian business houses, especially the sessions of policy changes and reforms done by the Indian government for Indian business houses, have been extremely informative for you, and you all must have gathered and accumulated a lot of big knowledge base for you people through these sessions. If you have any queries or any more information that you require regarding Indian business houses and the policy changes that were brought in the Indian scenario and Indian system, you're most welcome to pose your questions in the comment boxes. I will be very happy to answer to them. If you need the teaching notes and learning material also, we have our self-developed teaching notes at Ganyar University. I would be very happy to share the links with you people if they can actually benefit in knowledge advancement in the general public and the general learners. And if these sessions can support you in any way in your future further studies and career development, we would be really delighted. So with this, I have almost come to the end of today's session. So this is Dr. Swati Mishra from International School of Business Management at Suresh Ganyar University, Jaipur, signing off. Thank you so much for attending the sessions of Indian business houses. My best wishes for your future endeavors.